Ladies and gentlemen, good day and welcome to Q2 and H1 FY'25 earnings conference call of Yatharth Hospitals and Trauma Care Services Limited, hosted by PhillipCapital. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. Let me draw your attention to the fact that on this call, our discussions will include certain forward-looking statements, which are predictions, projections, or other estimates about future events. These estimates reflect management's current expectations about the future performance of the company. Please note that these estimates involve several risks and uncertainties that causes our actual results to differ materially from what is expressed or implied. I now hand the conference over to Mr. Amin from PhillipCapital India Private Limited. Thank you, and over to you, sir.
Thank you, Sejal. Good morning, everyone. On behalf of PhillipCapital Private Client Group, I welcome you all to the Q2 and H1 FY'25 earnings conference call of Yatharth Hospitals and Trauma Care Services. From the management, we have Mr. Yatharth, Full-Time Director, Mr. Amit Kumar Singh, Group Chief Executive Officer, Mr. Nitin Gupta, President Finance and Chief Operating Officer, Mr. Pankaj Prabhakar, Chief Financial Officer, Mr. Neeraj Vinayak, Head of Strategy and Investor Relations, and Mr. Sonu Goyal, Group Finance Controller. I now hand over the conference to Mr. Yatharth for his opening remarks, and we will then open the floor for question and answer session. Over to you, Mr. Tyagi.
Good afternoon and a very warm welcome to Yatharth Hospitals and Trauma Care Services Limited earnings conference call for the quarter ended September 30, 2024. We have uploaded our presentation on the exchange and the company website, and I hope you all might have received and have had an opportunity to go through it. I am pleased to report that Yatharth Hospitals have achieved exceptional growth in revenue and profit, surpassing 30% year-on-year in H1 FY'25. This performance underscores our commitment to high-impact growth strategies, operational excellence, and a continued focus on advancing healthcare delivery. Our expanding network of super specialty services, alongside the successful integration of the new Greater Faridabad Hospital, has been instrumental in driving this momentum. The Yatharth brand is now attracting leading doctors and specialists across NCR region, reinforcing our position as a trusted healthcare provider. Our commitment to clinical excellence is demonstrated by several noteworthy cases this quarter, showcasing the advanced medical capabilities at Yatharth Hospitals. Some of them are: number one, we successfully treated an elderly patient with a life-threatening 8-centimeter left atrial myxoma through a complex surgery involving meticulous excision of the tumor through an open heart procedure. Advanced cardiovascular techniques were employed to ensure the safety removal of the tumor while preserving critical heart structures, such as the mitral valves and atrial valves, resulting in a full recovery of the patient. In another instance this quarter, a rare gastroenterology procedure was performed on 2 male patients with severe acid reflux by successfully executing ARMA, anti-reflux mucosal ablation procedures, achieving discharge within just 24 hours of admission. Our team also performed a non-surgical cornoscopic removal of a giant rectal polyp in an 82-year-old patient with no complications and a symptom-free recovery within 24 hours, benefiting from procedure that minimized the risk of sepsis and avoided external incisions. In another scenario, an international patient with a recurrent retroperitoneal liposarcoma underwent a complex surgery to preserve the right kidney while completely removing a large 4-centimeter tumor. These cases reflect the high standard of care and cutting-edge treatments available at Yatharth Hospitals. I'm also proud to announce that our Noida Extension Hospital has recently been accredited by Joint Commission International (JCI), making it the first hospital in Uttar Pradesh to receive this prestigious recognition. We are also among the few hospitals to achieve JCI accreditation in a first attempt across India. This accomplishment highlights our commitment to providing healthcare of highest international standards and reinforces our position as a leader in quality healthcare delivery. Aligned with our vision to be a leading healthcare provider in North India, we are excited to announce our recent successful bid for a well-established hospital in Model Town, New Delhi, offering all the high super specialty services, marking our entry into the attractive market of Delhi. The acquisition is under the SAFESI Act 2002 through e-auction at an estimated cost of approximately rupees 160 crores. The hospital has an expandable bed capacity of 300 plus beds. We also recently entered in a strategic collaboration agreement to acquire majority stake in another 400-bedded hospital in Faridabad, Haryana for approximately 91 crores. This is our second acquisition in Faridabad following a Greater Faridabad acquisition in March 2024. Built on approximately 2 acres of land, the hospital has completed structure and is expected to be operationalized by the start of next fiscal. The company plans to invest additional rupees 100 crores towards equipping the hospital with latest medical equipment with all high-end super specialties, including full suite of oncology services and robotics. This acquisition enhances Yatharth Hospital's position as the leading healthcare provider with largest private bed capacity now in Faridabad region, and a critical step forward towards strengthening our reach in the NCR region. As we continue to scale our operations, we are committed to maintaining the highest standards of governance and transparency. Aligned to this, we have appointed Deloitte as our internal auditor, ensuring rigorous oversight of our process and reinforcing our commitment to best practices in governance and operational integrity. Overall, we are encouraged by the progress made in H1 FY'25 and are excited to build on this momentum in the coming quarters. Our focus on patient-centric, high-quality healthcare, combined with strategic acquisitions and investments in medical technology, will drive long-term value for our stakeholders. We remain committed to delivering exceptional care, expanding our network, and strengthening our relationship in the healthcare sector. I now hand over the call to Mr. Nitin Gupta for financial updates.
Thank you, Yatharth, and good afternoon, everyone. I am delighted to share that the Yatharth Hospital has delivered industry-leading growth in both the revenues and the profitability for the quarter and the half year ending September 30, 2024. Let me first take you all through the results for this quarter. During the quarter, Yatharth Hospital has achieved a revenue of rupees 2,178 million, reflecting a substantial growth of 27% YOY and a growth of 3% QoQ, driven by the growth in our occupancy and ARPOB. Notably, our Noida Extension Hospital registered the highest growth with a remarkable 53% YOY increase in revenues, now contributing 37% of our top line. Our inpatient volumes were up by 32%, while our outpatient volumes were up by 16% YOY in this quarter. We have also made significant strides in advancement of our tertiary and the quaternary care services. Earlier this year, we introduced our new radiation pipeline at our Noida Extension Hospital and robotics across our Noida Extension, Greater Noida, and the Greater Faridabad Hospital. These investments have significantly boosted our oncology revenue, with the oncology now contributing 20% to the Noida Extension revenue and 11% to the group's overall revenue, a fourfold increase from the last year. The shift towards the high-value super specialty services had driven a notably 11% YOY increase in our ARPOB, which now stand at 30,641 for the Q2 FY'25. Notably, Noida Extension achieved an ARPOB of 38,166, driven by its 70% contribution from the super specialty services, reflecting our focus on the high-end healthcare solutions. Our EBITDA for this quarter improved by 20% YOY to rupees 546 million, However, our EBITDA margin this quarter were at 25.1% compared to 26.6% last year. The reduction in the EBITDA margins for the quarter was on account of the operational losses at our Greater Faridabad unit, which become operational in the mid-May this year. Adjusting for the Faridabad hospital, our EBITDA margin would have been in the range of 26% to 27% for the quarter. Within 5 months of the operation, our Greater Faridabad hospital now contribute to around 4% of our top line, and thus we remain optimistic about the contributing to the Greater Faridabad facility in our overall group's revenue. Overall, our profit grew by 12% YOY and 2% QOQ at rupees 310 million. A relatively slower profit growth recorded due to an increase in the depreciation expenses in the quarter with the Greater Faridabad acquisition. Now coming to the half-year numbers. Our revenue grew by 32% YOY to rupees 4,296 million. Our inpatient volumes were up by 30%, while our outpatient volumes were up by 12% YOY in H1. Our overall group occupancy also increased to 61% in H1 25, compared to 54% same period last year. Notably, our Noida extension and the Jhansi Orchha have shown impressive occupancy growth, reaching to 60% and 47% respectively, compared to 41% and 19% in the same period last year. Our Greater Faridabad Hospital, operational since May 24, has also delivered solid occupancy growth. Our EBITDA for the half year stood at 1,083 million, up by 25% YOY, while EBITDA margin stood at 25.2%. Our profit for the half year stood at 616 million at 32% YOY. Our balance sheet continued to remain strong with a net profit position at rupees 1,541 billion. Our company's credit rating has been recently upgraded by the CRISIL at A- with a stable outlook, reflecting an adequate safety and the low credit risk of our financial instruments. Our return on the capital employed post the Faridabad acquisition came at 23%. Our substantial efforts to reduce our debtors by optimizing our payer mix has paid off with the working capital days at the end of September 24, reducing to 104 days compared to 112 days in the March 24, despite the high growth in H1. Looking ahead, we remain confident to not only sustain the growth momentum in revenue and the profitability, but also towards capitalizing opportunities had to achieve operational excellence and expanding our reach in North India. Thank you. With this, I would like to hand over to the moderator for the question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Poojan Shah from Malcius Venture. Please go ahead.
Hello, sir. Am I audible?
Sir, I would request you to please use your handset.
Yeah, sure. Hello, am I audible now?
Yes, sir. Please go ahead.
Yeah. So my first question would be on the Delhi, the acquisition what we have done from the Sarafati Act. I just wanted to know, like, what amount we will be trying to deploy for the restructuring and trying to implement for better structure coming years. And second question would be on the thing which is related to is it like what could be the ARPU possibility in this specific hospital and what we have been writing to what we are to specific in this thing?
Hi, good afternoon. So the Delhi hospital, the Model Town hospital that we have got through the FY Act. So, we will be paying around, if you add the expenses, 160 crores will go to the Union Bank, through which we have, won this big for this hospital. around 25% has already been paid from the company's book to the bank, and the rest would be, paid very soon. Above and beyond this 160 crores, we will spend a bit more on the upgradation of certain infrastructure as well as, upgrading the medical equipments. So we feel that infra updation and medical equipment should be costing somewhere around, 60 to 70 crores more. So overall, we see an outlay of 220 crores for this hospital. And, the hospital is located in a very prime area of model town in Delhi, with huge residential population residing across the area. There are a lot of renowned doctors also practicing in the nearby hospitals there. And we feel that it has a huge potential. The expandable bed capacity that this hospital can have is up to 300 beds. As far as your question on the RPOP is concerned, we feel the RPOP in this hospital will be more than the RPOP of our Noida hospitals, because in Delhi, the pricing is a bit higher compared to Noida and Faridabad. And also, we will be deploying super specialties from day one in this hospital. And, in the regions in the vicinity, the RPOP is also higher of other hospitals. So we feel around an RPOP of, somewhere close to 40,000 is easily achievable in this hospital.
And sir, you correctly said the expandable capacity is 300 beds. So what would be the current capacity as of now?
It would be close to 150 to 170 beds.
150 to 170. And my second question would be on the acquisition of Farida Hospital. Currently we have been investing 91 crore for 60% of the stake as per the enterprise value what we have been deriving it. And additionally we will be investing 100 crores. So how we have been planning to will it be the stake would be majority of ours, after that 100% of the acquisition, then we will invest 100 crores, or we will be keep investing on a 60-40% basis?
So we will keep on investing on 60%, 40% basis. 60%, is the acquisition cost that will be around 90 crores, plus more will be spent. Similarly, as I was mentioning, for upgrading Delhi Hospital, same will be spent in Faridabad to finish the structure. Certain minor work is still left, and all the medical equipment needs to be put in. Here, the medical equipment cost will be a bit more than the Delhi Hospital, because this Faridabad new hospital will also have the complete oncology machines. So it will have radiation oncology, PET scan, brachytherapy. So, similar outlay of the cost that, including the acquisition as well as the medical equipment, it will be almost would be similar to the Delhi hospital cost. And this will be, again, both these two hospitals, we are trying to operationalize from the first day of the new financial year. We might do a soft launch earlier. We might start OPDs earlier. But as far as the complete hospital launch is concerned, that's what we're right.
Okay, got it. And all the capex infusion would be via internal accruals, or we have been planning some of the debt also?
I think we have all the options open to us, and with time we will consider how to go about that.
Okay, no issue. Thank you, and all the best, sir.
Thank you. The next question is from the line of Mohit Mehra from Guardian Capital. Please go ahead.
Hi, thanks for this opportunity. This Delhi hospital, it was set up in 2019, right? How come this get operationalized by Q1 FY'26? I don't understand the long time period.
Okay, so this hospital is currently non-operational for last, almost 1.5 years. This hospital was earlier being run by a family of doctors who had got the hospital, and they were running it from the land, that forming a trust. But they faced some financial difficulties, so they couldn't continue the hospital, and the hospital went to the banks through whom they would have extended the loan to the previous promoter, and banks then further resell this hospital in an online auction. So, so the hospital has been, technically non-operational for last 1.5 years. So that's why, we would be upgrading it, making it operationalized, installing new medical equipments, recruiting doctors. That's why we plan to start it at the new fiscal.
Got it. And the land is also Yatharth for both the newly acquired hospitals, or will a rent we need to pay?
No, so the complete land, structure, and the buildings belong to us for both these hospitals. As it's a SAPESI deal, the Delhi hospital now, so all the land and the structure and the building is belongs to Yatharth hospital.
Okay, good. And what caused this sharp rise in employee expenses?
So, if you see, our thought process has been, last one to 1.5 years, is to get leading and renowned doctors across NCR. And because also we have started certain new therapeutic areas which we were not doing earlier. So new doctors were onboarded, and leading doctors, HODs from the hospitals have joined Yatharth hospitals and are currently also joining. So this could have led to a bit of increase in the employee the doctor cost.
Got it. But will this exert downward pressure on the margins, or you expect the revenue will more than compensate for the higher OpEx?
I think it will be sustainable. The quarter-on-quarter margins should be sustainable. So that's what we are targeting.
Okay, that's it from my end. Thanks.
Thank you. The next question is from the line of Priyank Parekh from Abacus Asset Managers LLP. Please go ahead.
Yes, thanks for the opportunity. Sir, I wanted to ask on the drop in occupancy in our Noida and Noida Extension Hospital. Of course, the ARPOB has grown well, but how should we read it? Is it a new trend?
So, see, as we had earlier mentioned that this dropping is mainly on the government business. And as we had mentioned earlier, that's the government, but what we do a very controlled manner, this government business. So as this occupancy of Noida and Greater Noida was inching towards, optimal utilization, so we thought of let's have some kind of sanitization on this business. And that's what you see. But impact is, if you see the other, the self-paying patients, has increased, contribution has increased. So you will see the next coming quarters, you will see the impact of this act. So this is a totally deliberation. There is no other thing on it.
And also the occupancy is hardly overall, it's 1 to 2% dip. So that's not a major occupancy dip. In fact, if you see our IPD volumes have increased, and that's the main aspect. And as Mr. Amit mentioned, it is what is more important to us now is the cash segment and the insurance segment has increased, and the government segment has decreased, which has only led to this decrease in the 1 or 2% of the occupancy.
Yeah, but there is a sharp drop in Noida hospital. I see it was running around 90%. Now it has come to 80%.
So this is what exactly I said it. See, if you look at that, where is that headway for the Noida hospital to grow? Because we can't grow in terms of, number of beds. That's the limitation which we had. So we thought of let's work on the, the payer mix and the case mix, right? And that's what this growth. And that is what you see the impact on even my LOS, which earlier it used to be higher because of this government. Now you see that this quarter is a bit lesser. So as I said, it's a totally on the control way. We know exactly what we are doing it, and then you will see the impact of the coming quarters.
Yeah, okay. So this level of occupancy will remain for upcoming years, right?
It will increase. It will increase, but now the incremental increase will be in the cash and the private insurance segment. This is why it might seem a reduction now because the government business has reduced now, and every incremental now will be at a higher ARPOB. So that's how the revenue will increase in an optimized, utilized hospital.
Yeah, good. Understood. Sir, what is our EBITDA loss in Faridabad hospital? Hello.
Yeah, so as we started Faridabad in the month of May, so in the month of May and June, it is the basically half of quarter, and Q2 is a complete quarter of 3 months. So there is a loss, but if you see the loss has been reduced from Q1 versus Q2. Q1 loss is around 256% negative, and Q2 loss is coming around 28% negative. Overall, we are on a better trend, and the losses are reducing.
Okay, understood. Sir, last question. So this 700 CR of QIP that we are planning, so how we are planning it to utilize? So first thing that for our recent acquisition in Model Town and Faridabad, I understand we are going to spend around 400 or 450 CR. Additional about that, how we are planning to spend it? Specifically, when we have 250 CR of cash in our balance sheet as of now.
See, we have a strong cash position, and we also have a strong leverage to take bank loans, right? So for us, the company can easily have the option to utilize the cash we have, and we can always take more bank debt as and when required. But at the same point of time, we are also keeping an option open, because as of now, these two are just not the only hospitals that Yatharth Group will be looking to add in the course of next 2 to 3 years, right? There are more acquisitions that will be coming up in next 2 to 3 years. So either we utilize the complete cash and take a bank debt today and, complete these two acquisitions that we have done in Faridabad and Delhi, but that would mean that in the years forward, that would restrict our growth into being aggressive in terms of the other assets that we are currently evaluating. So we are also keeping an option open where today we can, raise funds for just not these two hospitals, but also certain more aspects. So in the future, for next 2 to 3 years, if certain more bigger opportunity comes for acquisitions or greenfield, then we can take bank debt that time also. So it would continue to sustain the growth of number of beds that we are doing. So we are keeping our options open as far as that is concerned.
Understood. So if I ask you in another way, apart from this acquisition, what sort of planned capex we have for our existing structure?
For our existing structure, the planned capex we are already doing, and we plan to do from an internal accrual. So the brownfield expansion of the Greater Noida Hospital and the Noida Extension Hospital, where we are adding 200 beds and 250 beds each, this will be happening through our internal accruals. And, we see a capex of around 60 to 70 lakhs per bed for these two 450 bed additions that will be happening in 2 to 3 years' time. This is already being planned from an internal capex. And I would like to also apprise you that the Greater Noida capex, the brownfield expansion, has just started. So we are already on track with that. Any other capex that would be done other than these organic expansions would be done through the other funds.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants, please limit your question to 2 per participant. If you have a follow-up question, I would request you to rejoin the queue. The next question is from the line of Tushar from Motilal Oswal Financial Services. Please go ahead.
Thanks for the opportunity. Sir, this was mainly to do with the Faridabad. So we already just started this 200-bed Faridabad hospital, and now we are sort of getting this another, which will overall expand the bed capacity to say 600, like 400. So just to know your thought process as far as Faridabad as a market is concerned, where you're getting so bullish in terms of ARPOB or in terms of the demand, and given the backdrop that I guess there's a big 2,000-bed Amma hospital also there. I mean, of course, it's more from a social angle point of view rather than the profit-making perspective, but just your thoughts on Faridabad as a market first. So that's my first question.
The reason why we've added one more hospital in Faridabad, which is 400 beds, and it's a much bigger hospital, will be, we feel that, first of all, the 200-bedded hospital is in Greater Faridabad region. And then this 400-bed hospital is in the old town and main city of Faridabad. So technically, there would be, 15 to 20 kilometers gap between two hospitals. And if you see at the history of the company, that's what we did in Noida. We first started the small hospital in Greater Noida. Then we started in Noida. Then we went to Noida Extension. So we feel that once you become a big player in a city, your brand is able to, attract much more, patients and doctors. Being a small player of just 200 beds in Faridabad, it's not that easy to compete with other hospitals which are 500 beds or 600 beds or 300 beds in that region. But now, because we will have a capacity of total 600 beds, we'll be almost one of the largest private player in that region. So that will be able to sort of benefit us in terms of our brand positioning is concerned. And another reason you see is that even in terms of star doctors, the same cost can be shared between two hospitals. We can actually leverage our, profitability and expenses and divide them the same for two hospitals. This is what we even did when we started hospitals in Greater Noida and Noida. So it sort of benefits us in terms of our, managing our expenses is concerned. And, obviously, third thing is, your brand positioning and is very important. So now, with 200 beds, it's not that easy to attract the leading doctors of Faridabad. But today, as soon as we have announced the 400-bed hospital, even a 200-bed hospital will now benefit because same star doctors are now willing to join us and work in both the hospitals as head of departments. And so we feel that Faridabad in general is a good hospital market. It is an ever expanding market. There's a road which is even connecting the Jewar Greater Noida Airport to Faridabad. So, even that city will benefit from the upcoming airport that is being planned in Greater Noida. And if you look at the, the competitive landscape in Faridabad, I think everybody is doing well there. So we feel this city, which is actually even an older city compared to Noida and Gurgaon, is now undergoing a massive expansion. There's a huge population drainage that comes from the, the nearby villages of Haryana, including Palwal, Sona, Agra, even Agra, Mathura highway connects to that region. That's why we feel, and we feel that it was a no-brainer decision for us to take. Even the doctors who had joined us at the 200-bedded hospital used to say that there's a hospital which is 400 bed available. We should definitely look at it, and it is actually from the common consensus that we did the study. We felt that it is a perfect choice for acquisition.
Got you, sir. Interesting. So currently, what is the, I missed, so this is proposed up to 400, but currently what is the capacity?
It will be starting as a 400-bedded hospital because it is a new hospital that is starting up. The structure is now complete. Some more months it will require for the interiors to happen. So we will start it as 350 to 400 bed operationalized in that hospital.
But we'll go in a phase manner, definitely, by looking at the occupancy and other things.
Understood. So broadly, what kind of ARPOB can be expected from now this 400 bed where you can attract clinical talent as well as super specialty compared to say 200 bed earlier?
So I think we feel that the ARPOB that our Noida Extension Hospital is having, which is one of the highest ARPOB contributor to our overall group, which is having close to an ARPOB of 38,000 rupees. We feel the bigger Faridabad hospital can at least start off with a similar ARPOB, and it can even go beyond because we are not just planning to start specialty services. We will be starting liver transplant there, bone marrow transplant. So it will become a center of excellence for the whole region.
Thank you. The next question is from the line of Virat from Skyridge Wealth Management. Please go ahead.
Hello, thank you for the opportunity. Just need some better understanding regarding New Delhi Hospital. You mentioned it currently has a capacity of 150 to 170 beds, and you will be spending close to 220 to 230 crores for the hospital, including upgradation. So will you need to spend extra to get to the 300 mark, or will the 60 to 70 crores for upgradation will be enough for the expansion to reach 300?
It will be enough for expansion. So when we say 220 crores total outlay, that includes the 160 crores acquisition cost, plus around 60 crores would be spent. The upgradation of 2-3 floors doesn't cost much, and that's all what will be required. Just 2-3 floors needs to be constructed. Rest, medical expense can always be almost same for 170 to 300 beds. So, the cost is including in that.
All right. Just some question on your internal rate of return requirements and payback period for which you acquire the hospitals for. Like, what's your internal target? And also your maintenance capex figure would be helpful.
So the payback period, we presume that it may be by 2 years, probably the kind of average period we say proceed.
2 years is the break-even period that we are looking at, and I think 3 to 3.5 would be the fair payback period is what we are looking at.
And maintenance capex, sir?
So maintenance capex wouldn't be that high because, it's a newer hospital. So all the machines and equipments will be new. I think so maintenance capex will not be yearly, not more than 15 crores will not be the maintenance. It is more than that.
Thank you. The next question is from the line of Sumit Gupta from Centrum Broking. Please go ahead.
Yeah, hi. Thank you for the opportunity. Sir, first question is on the overall margin. So, like previously used to guide around 27% margin. So now going forward, can we expect it to be around 25% margin over the next 2 to 3 years?
So, we have always talked about sustaining our EBITDA margins close to 26%. 25 to 26%. And if you look at even with an increase in the doctor expenses Q on Q, even with the increase in the business of cash and private insurance segment, national business is increasing. Our share of super specialty business is increasing. Even then, our margins are almost, if you say from last quarter, it is close to that. It's not a variation much. So we feel that the margins that we have now of 25.5 to 26% should be sustainable.
Okay. And how much would be the mature hospitals would be making?
So mature hospitals would be making, if I talk about, Noida Hospital, the margins there should be very close to 29%. If I talk about other hospitals, so somewhere around 28 to 29% is our mature hospitals would be making.
Okay. And sir, another question is on just Jhansi Hospital. So why has the ARPOB declined to like nearly 12,500 versus if I talk about FY'23 or FY'24, it was around 18,000. So, and is there any further room to grow for this ARPOB?
Yeah. So first of all, if you look at Jhansi, it's a margin not as per expected because last year, Q2 24 versus this quarter, probably this half year. See, initially we had no empanelments. The governments and other things, other types were not there. So mainly, the cash patients were more, right? As we grow, as we get the empanelment, so slowly, as you know that, government panels will always, drag you in the margin. So this is more of the volume, and I think this is not a right time to look at it. Probably the few more quarters, I think the colors will be seen better in a Jhansi hospital. I think we would be in a average what we had talked about, anything between 15 to 20,000. I think that's what our expectations from the Jhansi hospital. I think we're able to achieve it.
Thank you. The next question is from the line of Gaurang from HSBC. Please go ahead.
Hi, am I audible?
Yes, sir.
Yes.
Yeah, hi. Thank you for this opportunity. Sir, I just wanted to understand the evolving, competition dynamics in your Noida hospital, given that Max has opened its new hospital, as in the acquired hospital just near your Noida hospital. It's just 2.5 kilometers away. So, do you feel that there is a very meaningful change in terms of how our business model is affected by Max opening the hospital there?
See, as far as the Noida region is concerned, our Noida Extension Hospital is the first hospital in the region ever to get JCI accreditation. And it just got JCI accreditation a few weeks back. JCI accreditation, not just in Noida, is the first hospital in UP, Uttarakhand, and the nearby vicinity to get that. And that was a thought process. As we feel that there are new players who are entering into the market. We also need to constantly upgrade ourselves in terms of our quality standards, in terms of getting more doctors is concerned. So it's something that we are doing regardless of who are entering, who's not. We also feel that it's actually good for the Noida market that other big players are now entering here. If you look at what is happening in Gurgaon, this is probably now Noida's time to happen because all players started this journey in Gurgaon probably 70 years back. And if you look at the market which is developed for all hospitals being present there, more doctor talent moves there, more ecosystem for international patients develop, more facilities develop, and this mindset of, Noida patients to going to Delhi, to going to Gurgaon shift as more hospitals open up in Noida. So we feel it's good for the Noida market. We are constantly evolving, upgrading our accreditations, quality standards, and we feel that in the long run, it will be beneficial for everyone.
Okay. Sir, and just extension to this, and sorry if I'm being ignorant about your comments on doctors' cost going up, but are doctor costs going up related to this incremental competition? Is it like a defense mechanism that we have employed to sort of curtail any poaching that may or may not happen?
No, our doctor costs have or is going up as an intentionally, and that's a strategy that we have deployed. See, a few years back, we used to not have star doctors. When we started with a small brand, we used to have doctors who were second in line to the star doctors, who were equally experienced, who were equally skilled, who were driving volumes. But today, I think the brand is able to attract all the leading star doctors and HODs who are a bit heavy cost model, but then they bring their own benefits. And that is also a reason why we are seeing our cash segment of the patients, private insurance segment of the patients increasing. It is actually because of these star doctors and the cost that we have incurred. And it is just starting phase. Their complete, return will come in the quarters to come when they will be even justifying their cost and doing much more volume than the cost layout to them. So it is a strategic call that we have taken. It has nothing to do keeping in mind with the competition.
Thank you. The next question is from the line of Prashant Nair from Ambit Capital. Please go ahead.
Thanks. Good afternoon, everyone. Just one question on the seasonality that usually plays out. This year, we haven't seen much difference in revenue between the first and second quarter. In fact, if you take Faridabad out, it's probably flat, and it appears that the Noida hospitals have actually seen dip in revenues quarter on quarter. So what has changed in the normal pattern? My understanding was that second quarter is usually seasonally stronger.
So, this time it's not that, quarter two had some higher seasonality. We feel at least in the markets that we are operating, there wasn't any breakout of some, major dengue or certain other flu, which usually happens during Q2. So yes, it wasn't there this time, at least in the regions we are there. And second thing, as we mentioned earlier in the call, it is a strategic decision where, certain percentage of the government business that we have reduced, specifically in the mature hospital of Noida, in order to optimize better the growth in the incremental occupancy from here on for a higher ARPOB growth in the future to come, is a call that we have taken. If you look at their private insurance business and cash insurance business across all our hospitals, they have increased quarter on quarter. It is just the government business that we have intentionally, kept a check on. So as far as the seasonality and that is concerned, I think that's the way.
Okay, that makes sense. How much would share of government schemes have come down to in your? I'm sorry if you have already mentioned this. I missed it.
So we have reduced government business close to 4% quarter on quarter. So our thought process was that at the H1 level, we are almost down 6% compared to the last year's government business concern. And we feel that if we are able to reduce government business close to 8% for the whole year, that is what we are targeting on. So we feel that when we say in next 2.5 to 3 years, we see a government business reducing to 25%. That's how we are able to do it. That's how. So we have to start now in order to achieve that in 2.5 years' time. But more importantly, as I said, it's not that we are just reducing government business. We have also increased private insurance and cash segment. That is more important to us simultaneously.
Thank you. The next question is from the line of Arpit Shah from Stallion Asset. Please go ahead.
Yeah, hi. Am I audible?
Yes, sir.
Yes.
Yeah, congratulations on good set of numbers. Just wanted to understand a little bit of the doctor cost, which we have seen a substantial jump. I do understand that we might have hired star doctors from other hospitals for the newer therapy that we are starting at Noida Extension or Faridabad or at any hospital. So when should we see a significant or subsequent jump in ARPOBs going ahead? That would be my number one question, because the star doctors would actually take your ARPOBs higher. That is what my belief is. And that should also help you to expand your margins going ahead.
So if you see that, in fact, we have probably the 10% increase in our ARPOB. So as earlier mentioned, that so the new, treatment modalities added in the systems, and Faridabad is a new, infrastructure. So that's what you see the increase in the cost. And once these, the doctors actually start kicking the departments, you will see that impact, which impact will be on ARPOB and in terms of the revenue as well. So we are very comfortable with this as of now, the doctor cost, and we are keeping eye on it. But impact you will see in the coming quarters.
Got it. And how should we see the revenues, let's say for FY'25 and FY'26, given that some seasonality was weaker in Q2 this year? How should we see that number for FY'25 and 26? And despite that, in 26, we're going to see addition of 2 new hospitals getting added to the PLN. How should we see the numbers for 25 and 26?
I think the percentage growth that we are seeing year-on-year growth this time, it will certainly surpass that, and we do expect a higher year-on-year growth, even though we are already delivering industry-leading year-on-year growth. But from 25-26, we do expect this growth to be much more. At the same time, we feel that EBITDA margins should be sustainable to what they are, in this quarter.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants, please limit your question to one per participant. If you have a follow-up question, I would request you to rejoin the queue. The next question is from the line of Rishit Shah from BFly India. Please go ahead.
Yeah. Thank you for this opportunity. My question is regarding the occupancy drop during the quarter-on-quarter to the management.
So I think we have already answered it, that the occupancy, if you look at it, this drop of occupancy of 1 or 2%, just it's a deliberate, as a management call. As I mentioned earlier, that we do a government business with completely in a controlled way, and that we thought of to increase the other payers. So this was the call, and which definitely will have an impact on the coming quarters.
Thank you. The next question is from the line of Nirali Shah from Ashika Stock Broking. Please go ahead.
Hi. So I just wanted to ask on this recent acquisition in Model Town in Faridabad. Can you outline what is the plan in terms of how it will be contributing over a 2 to 3 years horizon?
So I think if you look at the contribution that the Greater Faridabad Hospital has started off, I think the Model Town Hospital will be on the similar line. But the Delhi Hospital will obviously have a much more contribution to our overall ARPOB is concerned. And we feel that the case mix will be very optimized here. And also it's important to note that from now on, all the new hospitals that we are adding, whether it's Greater Faridabad, which we're already showing, or the Model Town Delhi, or the newer hospital Faridabad, will have a very high share of private insurance and cash TPA segment. And the government business will already be close to 20-25% from day one, of those new hospitals. So this is why that's more important for us to, work on our KPIs as far as the new hospitals is concerned.
So any hospitals when we take, and so to fulfill, because that bed capacity is already there. So fulfill that initially, we tend to take a more empanelment government business. But as the other players increases and capacity inches towards the optimum side of it, it's automatically we reduce it. So this is how the pattern one should operate.
Yeah, and for the newer hospitals, as we said that. It will not be even required for us to take a lot of government business in the beginning. So we will be keeping that in check for these Delhi hospitals and Faridabad.
Thank you. The next question is from the line of Ritika from Perpetuity Ventures LLP. Please go ahead.
Hi. So just wanted to know who is the minority shareholder for the Faridabad hospital.
So the majority shareholder is a family who have a company called MGS. They do not operate any other hospital. They are into other businesses, and they made this hospital because one of their sons is a cardiologist doctor. So they thought of constructing the hospital, starting it. But then they feel it will be better for them to partner with a healthcare specialist firm in order to drive the maximum value from that hospital. So they would be the 40% partner in this hospital.
Thank you. The next question is from the line of Shubham from Perpetual Capital Advisor. Please go ahead.
Hello, am I audible?
Yes, sir.
Thank you for the opportunity, sir. So, sir, just had one question. Can you please share what kind of EBITDA margins you generate in different payer categories, except for the healthcare versus insurance segment versus government business?
So you are asking a forward-looking number, so we don't want to give you any forward-looking number as of now. But yes, as you do in a more and more complex and high-end, surgeries, just EBITDA margin bit compromised over there. But this is what I think you do a business. This is what you wanted. So as of now, I think there is no forward-looking number I can give you.
Thank you. The next question is from the line of Priyank Parekh from Abacus Asset Managers LLP. Please go ahead.
Yeah, thanks for the opportunity again, sir. My only question is about the maintenance capex that we have to do for our mature hospitals. Any per bed number you would like to give?
As I already mentioned, the maintenance capex is usually very low unless and until we upgrade or add a facility. And we feel that in our all mature hospitals now, every facility has been added. We have already done actually a lot of capex in the last quarter if you look at. But that is for the upgradation of new services. So we added robots, we added new equipment. Maintenance capex for the whole thing, as I mentioned, will not be close to even more than 15 crores for the whole year.
Thank you. The next follow-up question is from the line of Sumit Gupta from Centrum Broking. Please go ahead.
Hi, thanks for the opportunity again. So just want to understand on the Model Town Hospital as a whole. So basically, like we have one competitor, Shalimar Bagh is also near to this Model Town Hospital, which is just nearly 15-20 minutes drive. So how do you see the competitive dynamics panning out? And apart from that, what is the strategy for this hospital over the next 4 to 5 years?
See, yes, there are good hospitals nearby, but still that area, if you look at it, Delhi population moves 2-3 kilometers around, right? So the civil line is absolutely the old and, very high-end societies are there, high-end residents living there. So we believe this is a strategically wonderful location. And then for us, entering into as far as strategy is concerned, we are very much aware with the competitions over there. So we'll enter into all those things keeping in mind. And the one thing is sure that we're going to provide the very high-end tertiary and quaternary care in that particular hospital.
See, I think what's also important is being an old area, and there are a lot of leading doctors who are already practicing in their own clinic. And our thought process will be to add those doctors who have a very high individual practice at their clinic to our hospital. Some of them have actually started contacting us already because that area, as I mentioned, that people tend to move to hospitals where their own family GP or their own family doctor is. So our strategy would be to again add those doctors in our hospital, and we have a huge growth potential from the Model Town Hospital.
Thank you. The next follow-up question is from the line of Arpit Shah from Stallion Asset. Please go ahead.
Yeah, hi. Thank you for the opportunity again. I just want to understand margins in FY'26. Given that we'll be starting in at least with new 700 beds, will you be still able to sustain 25-26% margins on the consolidated level, or you see a dip on that?
So we feel that we will be able to sustain the EBITDA margins. Reason being that yes, there are 2 new hospitals that will be starting, and there would be certain drag down due to that. But because our hospitals of Noida Extension and Greater Noida will also expand in margins. There's still occupancy ramp up that is yet to happen in Noida Extension Hospital, which is close to around 60% of occupancy in this quarter. And even Greater Noida will further grow because of, the airport coming in. Now, when the occupancy ramp up in these two hospitals happen, their EBITDA margin will further increase. So at the group level, they will compensate for the drag down from our newer hospitals. So that's why we are confident of sustaining EBITDA margins like we have, quarter on quarter.
Thank you. The next question is from the line of Naman from Nine Rivers Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. I have two questions. First is on the employee cost. Can you provide the split between the professional fee which is paid to the doctors like every other peer in our industry provides? And second is the occupancy ramp-up number which we have planned in terms of the newer acquisitions which you have done recently, as well as Jhansi and the recently incorporated Faridabad hospital in May over the next couple of years.
So, coming back to the second question first, I think again I said it, there is no forward-looking number, but I think the Jhansi and Faridabad is doing really good. If you look at it quarter and quarter, Jhansi hospital has done 48%, 20% to 48%. So it's a very good jump. Similarly, Faridabad also. As far as new hospitals is concerned, I think as of now, there is no forward-looking number. And that, what was your first question? I missed it.
It was related to the employee cost as in the professional
Yes.
which we pay to the doctor.
Yeah. So as we are growing organizations, initially, as of now, you see there is some, some employee cost will be higher because of the kind of the group is growing. There are two hospitals coming up. The existing hospital already, adding a lot of new, specialties. But as far as this concerned, we understand that we're keeping around 14, 15, 16% of the professionals and 18 to 20, 22% of kind of, other employee costs. I think these are the percentages we have in mind, and I think in coming quarters it will be settled on the debt.
Thank you. Thank you. The next question is from the line of Prerna from PNARS Partnerships. Please go ahead.
Yeah. Yeah. Hi, sir. So I have a couple of questions. First thing is regarding the new acquisition that you've done in Delhi as well as Faridabad. What is the empanelment status with the government and various other medical insurance companies? And the second is, with the, you've done these acquisitions, of course, little bit could be there is an EBITDA there. So going forward for this FY'25 year, what is the expectation, PAT expectation, or even if you could guide on telling, what is the PAT margin? Will you be able to sustain the FY'24 PAT margin?
So, as far as this first question is concerned, the empanelment for government and private insurance happens once you start a hospital. They can't happen without the hospital being operationalized. So because we are operationalizing the hospital from the new fiscal, and it is something that they were not running hospital and it's been quite a while, so they have to be fresh empanelments and they will take few months to happen. Unlike the Greater Faridabad hospital, where there were a lot of private insurance that were already empaneled, in these two new hospitals, it will take some time for us to empanel both private insurances as well as government empanel. As far as the second question is concerned, we said, the EBITDA margins we should be sustainable because of, the increase in the margins in our matured hospitals, even though that will compensate from the drag down for the newer hospitals. So I think that's what we can tell us.
Thank you. The next question is from the line of Akshaya Shinde from Smith Limited. Please go ahead.
Thank you for the opportunity. Just wanted to understand, as we are hiring star and leading doctors in the region, so does that mean we are shifting to the doctor-led model, and how we are going to de-risk in the long term?
So it's, having star doctor is not that you are fully, focusing on doctor-led model. Ultimately, it's always a mix. A patient chooses to where to get his surgery done, not just based on the doctor's reputation, but also the reputation of a hospital. So it always goes hand in hand. Just because we are attracting, leading doctors, simultaneously we are also doing our own separate marketing of the hospital, reaching out to the communities, showcasing and building on our quality standards like the JCI accreditation that we have done. So we are simultaneously doing a holistic approach, and that's how we will be always deleveraged from choosing just one single model.
Thank you. The next question is from the line of Siddharth from K Price Holding. Please go ahead.
Yeah. So hi, sir. This is Siddharth. So in Q1 Concall, I asked if we can hit 1,000 crore mark. I mean, you said that we could end up close to 1,000 crore. But looking at the current run rate, I think it's a bit difficult. So just wanted to understand if if still that 1,000 crore guidance which you unofficially gave in the last quarter still holds true or not. Yeah.
I think what we said is we will be closer to that, mark. It's not that we said that we will surpass or touch that mark. So I think we still maintain that. We will be very close to that mark, and I think the company is on track with that. And we do expect, Q3 and Q4 to be good growth quarters. Typically Q4 should be even higher than the previous quarters, and because of certain new therapeutic areas maturing, certain new more doctors coming up. So I think we do expect, quarter-on-quarter growth going forward, and we will be very close to that mark.
And so one more question, sir. So you said that the margins of last year, that is roughly around 28%, right? Yeah. So will be is it 28-29%? Is that sustainable or the current margins? I mean, this quarter margins are sustainable. I just have a question on that.
It's not that we had 28-29% margins. I think our EBITDA margins were very close to 27. Somewhere between 26 and 27. And so this is if we talk about quarter-on-quarter, we have been close to 26%, and this is what we will maintain, somewhere between 25 to 26%. That will be the target, going forward also.
Yeah, even if you compare to the last year numbers, previously in the last year, there was no new unit which has been added there. So when we see the current quarter numbers for the EBITDA margins, so that been diluted by nearly around 1.5%. If we add that, then we will be clear to around 26 to 27% to reach the same numbers as well.
Thank you. Ladies and gentlemen, due to time constraint, we will take that as the last question. I now hand the conference over to Mr. Aman for closing comments.
Thank you. On behalf of PhillipCapital India, we thank all the participants for your valuable time, and especially the entire team of Yatharth Hospital and Trauma Care Services Limited. I would now hand over the conference to Mr. Tyagi before his closing comments. Over to you, Mr. Tyagi.
Thank you, everyone. Thank you for all your questions, and thank you for attending the earnings call of Yatharth Group of Hospitals.
On behalf of PhillipCapital India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.